Wow. I go out of town for a few weeks, and what happened? Did you all miss me? Um, yeah, a lot of stuff seems to have kind of changed a little bit in the real estate market. So I want to talk about that. I want to talk about some context first before we dive into the numbers, because the numbers need some contextualization to make them more understandable. Because there are a lot of people out there who are talking about numbers without context and making comparisons that are inappropriate to, perhaps purposefully, maybe non-purposefully, to make claims where those claims are distracting and misleading and potentially dangerous. So let's go ahead and talk about some of these things. And let me preface this with who I am and why I'm doing this. So regular viewers, you know, I'm Justin Miller, co-founder and principal with the Chong Miller Group, a Las Vegas-based real estate team associated with Keller Williams Marketplace One. We help people buy and sell homes at the Chong Miller Group. And so I started a few years ago putting out market update videos to educate the public as to what's going on in the local real estate market. About a year ago, I started to segregate multifamily out from the main video. And so this video right now is the August update for resale single-family residential in the Las Vegas Valley. And there'll be a companion video for multifamily, meaning condos and townhomes resale in the Las Vegas Valley, also for the month of August 2022. Now the data, and we'll get to the data in a little bit, but the data come mostly, not exclusively, but mostly from the multiple listing service here in the Las Vegas area. And the data are representative of, in fact, they are population descriptive statistics of what happened over the prior month. So the August video, the data were pulled on August 8th. Normally I pull on the 7th of the month, but the 7th was a Sunday, meaning there were no updates on Sunday. So the data were pulled on August 8th, and that's as I'm recording the videos. And the data described then what happened in the month of July in the Las Vegas Valley. Some of that data is specific to things that occurred and are backward looking, and some of the data, as we discuss in the video, are forward looking, such as pending home sales or newly written contracts that have not yet closed. And so that's the primary purpose of the videos. However, over time, I've come to learn that there are a variety of people who are actually watching these videos. Some are potential home buyers, some are potential home sellers, some are actually other real estate agents, some are loan officers in the Valley. And so I want to make sure that I'm putting out information that's meaningful to the communities that may be watching these videos. And that means it's not just simply hard numbers for market updates so you have an idea of what your house might be valued at, for example, or the house you want to acquire, but rather more context so that you have an understanding about what's going on in the environment, how that's changing prices or impacting the potential change for prices, giving you more knowledge. So as many of you know, I did my undergraduate studies at the U.S. Naval Academy. And at Annapolis, we had a motto. It's on our class, our school crest. Ex scientia tridens. From knowledge, see power. Well, I believe very strongly in the concept behind that motto. And so I don't know how to say real estate knowledge or real estate power, but ex scientia real estate, right? So from knowledge, you've got a greater command of what's happening in the real estate market, as well as whatever else that the data, the information, the knowledge that gets shared may be. And so you're able to make more informed decisions that end up helping you considerably. And at the Chong Miller Group, we do help people buy and sell real estate. And we'd love to help you. If you're watching these videos, you're obviously the kinds of people who are benefiting from our analytical skills and like listening to what I have to say from the perspective of you find it to be educational and helpful. Please reach out to us. Be happy to have a conversation with you. Maybe I can help you. Maybe I'm not able to help you, but let's have a conversation and we can find out. And I'll look forward to talking with you. And please feel free to leave comments as well. I engage with the comments, and unless you're advertising some other place, in which instance I'll ban you, most of the comments are perfectly fine. If you're using my comment page to flame things, then you'll probably get banned as well. But otherwise, we're a community of people interested in real estate, whether that's investors or potential first-time home buyers or property owners looking to sell, downsize, upsize, or someone else involved in an ancillary role in the real estate transactions. We're a community of people here, and you're more than free to interact on my page. Leave comments. I'll gladly interact with those comments. All right. So yes, I was out of town for the first 3 weeks of July. And so I left on July 1st a very quick market update where I looked at pricing, because that's the only statistic that had been quasi-reliably knowable on the first of the month. And we've talked about this before. The data set into which all of the data gets updated based on transactions most days, not on Sundays. And so one would expect that, hey, we got to August 1st, we know everything that happened about July. Well, unfortunately, that's not the case. We actually need to have about a week of time for the data to settle, to correct some errors that materialize in the data set every month, and to allow transactions to conclude and be recorded into the data set. And so there are lots of revisions that take place between the 1st and the 7th. After the 7th, the data tend to be relatively stable, although some additional changes may apply. So on the 1st, the only data point that's close to stable is the median sale price. And so median sale price, I had left you on July 1st, that median sale price for June was $480,000, which was flat from the month prior, from May. So upon update, once we got to the 7th, and looking back now, actually median sale price for single family homes was $478,000. So it was down $2,000 from the prior month. So it was close to stable data, but not fully. And so what actually happened is June's median sale price was $478 for single family resale in the Las Vegas Valley. Now, there have been a lot of articles over the past month. That was the first drop in prices in more than 2 years. It's actually not true. There was a drop in price from November of 2020, December of 2020, so over a 2-month period. Prices for single family resales have actually fallen by $4,200. So that's well within the past 2 years. And right, that's not because of the pandemic, because pandemic price related issues really manifest themselves only in April and May of 2000. And then we started getting these significantly escalating prices. But there was a break, a 2-month break. And during that 2 months, in late 2020, prices went down by $4,200. We had another break, a 1-month break in 2021. Prices, single family resale residential in the Las Vegas Valley from July 2021 to August 21, 1 month, fell $1,750. And so the reality is that in 2022, we had prices fall from May to June, that month, by $2,000. So nothing particularly unusual about that, although the press has been going wild. It's the first time in more than 2 years and blah, blah, blah. A lot of not just fake information, but a lot of alarmist claims around statements that are not true, just categorically wrong. And that information is making it into the news media. It's published by the official real estate writers for the official newspapers in Las Vegas. It's on all the blogs and video channels out there across YouTube, and it's just plain wrong. And so I caution you, when you listen to things, you try to get information, you're looking broadly, take what you're hearing with a grain of salt, because a lot of it is wrong. I'm Justin Miller. I'm one of the co-founders and principals of the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. I'm going to ask you to do me a favor. Please smash the like button, subscribe if you haven't subscribed, but also please, if you know somebody who's in the market to buy, in the market to sell, thinking about possibly engaging in a real estate transaction, please send my video to them. They can reach out to me then, right? It's a very soft introduction from you. If you think this is interesting, if you think this is informative, if you think this is helpful, if you think it's great to cut through the chatter and the bleak assessments that are out there in the social media market space, please feel free to forward my videos, share my videos to your friends, your colleagues. Let them then decide if they want to reach out to me. I really appreciate it. It will allow for better information to get to people who need that information. So let's talk now a little bit about some context, and then we'll go into the data for the month of July. So a couple things have transpired over the last basically 2 months since I've given you a real market update. One of those things is the Federal Reserve has continued their tightening policy, and they have been raising interest rates. And so last month they raised interest rates on, I think it was July 27th. They raised interest rates, specifically the federal funds rate, that's the only rate they literally control, by 0.75 points, or 3/4 of a point, or 75 basis points, right? Those are three different ways of saying the exact same thing. A basis point is 1/100th of 1%. 75 basis points, 3/4 of 1%. That's a really big increase. And they had done it the month prior. In June, they had increased the Fed funds rate by 75 basis points. So over a 5-week period of time, the Fed funds rate increased by 150 basis points, or 1.5%. That's a really steep increase in the Fed funds rate. Now, what's the Fed funds rate? The federal funds rate is the only rate controlled directly by the Federal Reserve. It is the overnight lending rate that the Fed will provide to banks. Very short term. It's overnight. It's very controlled. It's loans from the Fed to member banks. In case they have a capital reserve requirement or a liquidity problem that manifests itself for a very short period of time because of trading issues or things like that, the Fed allows member banks access to funds. Well, what's that have to do with a mortgage rate? Nothing. It's a signal to the market, to the bond market, that the Fed would like interest rates more generally to go up. But it's a signal. It's a communication tool, and that's realistically all that is. So who are they communicating to? Well, they communicate to the general public, meaning they're trying to let the general public know, hey, we think interest rates should go higher because we're worried about inflation, so we're raising interest rates. Okay, great. A little bit meaningless, but they're communicating a little more specifically to the bond market, and there are actually, you could dissect the bond market and say there's the bond market for 30-year treasuries, you could say there's the bond market for 10-year treasury notes, you could say there's a mortgage bond market, right? So you could look, there's the auto bond market for auto loans. In each of the individual areas of the bond market, then get to interpret the communication signals coming from the Federal Reserve based on what they did with their statement and their change in interest rates on the Fed funds rate. So the Federal Reserve started increasing interest rates earlier this year. They took them from a range of 0 to 0.25%. And now they're considerably higher because in the past 5 to 6 weeks alone, they've increased the Fed funds rate by an entire 1.5%. Right? It had been at the beginning of the year at 0%, and we've just had 150 basis point increase in the past approximately 5 weeks. That's a really steep increase. Why is the Federal Reserve doing this? They say they're concerned about inflation. And to get rid of inflation, they are willing to slow the economy by reducing demand for money, borrowed money, by increasing the cost of that borrowed money, increasing the interest rates. Of course, again, they're only signaling to the market because very, very few people or entities can borrow with the Fed funds rate. So bond traders in their virtual bond trading pit, because I'm not aware of any bond markets that actually now transact, buy, sell in an actual physical pit as used to be done. So in a virtual pit where buyers and sellers of bonds meet. What are bonds? Bonds are loan instruments. So somebody buys a house, they take out a mortgage. That mortgage, that's a bond, right? But the individual loans can be packaged together. And so we could create mortgage-backed securities, and the market does this, packages of mortgages. So a whole bunch of 30-year mortgages get packaged together. They're a bond, a mortgage-backed security, an MBS, and they get traded in the mortgage bond market. Well, when the Fed started increasing interest rates earlier in the year, a lot of bond traders became very concerned about both higher inflation but also higher interest rates. And so they started to become less interested in owning mortgage-backed security bonds as well as other bonds. And so they stopped buying them. Well, if you stop buying them, your demand goes down and you don't buy. You stop buying those bonds, what happens? Well, the price of the bond has to come down to entice people to buy bonds, right? Because if I could get this pen at $17, probably don't want it. But if I could get this pen at 5 cents, maybe I need a pen and I'll pay 5 cents for it, right? So as prices come down, demand increases. So low demand causes prices to come down because people are not buying. Prices come down until demand rematerializes in the market. So that suggests prices are coming down in the mortgage-backed securities market. But I said interest rates have been going up. Well, interest rates are exactly inversely correlated to the price of a bond. As the price of a bond comes down, the corresponding interest rate, a different type of measure, the exact same thing, different type of measure, noting the exact same data point, goes up. So it's a one-to-one correlation, meaning a direct correlation. It's not 1% to $1 or something like that, but there is no give and take. It's an exact linear correlation, consistent across the entire pricing spectrum. Bond prices come down because fewer people are interested in owning them, which causes interest rates to go up. Well, that means people who are buying the bonds are able to get a higher interest rate return. Right? The price went down, the interest rate went up. So not only do they pay less, it means then that less amount of money that they paid is buying them a bond that returns a greater interest rate. Well, if the buyer of that bond is getting more interest, the only way that happens is if the borrower, who along with the lender wrote that mortgage note, is also paying higher interest. So there's a direct correlation between what the mortgage-backed securities bond market is pricing bonds at and the interest rate that is then asked for by lenders in the mortgage market and in the 30-year treasury market and et cetera, right? All interest rate markets, all loan markets. So car loans, have gone up, and etc. Well, on the supply side, for the writing of those loans, there are, of course, other factors that come into play, right? We know then what happens when it goes into the marketplace for packaging as an MBS and gets sold. But on the sort of creation side, the individual loan, if a bank has a team of loan officers and loan processors and etc., all the people involved in the lending process, and no one's borrowing money, that lender, that bank, that whatever the lender type is going to start laying people off, and or they're going to lower the interest rate that they're going to charge to particular borrowers on loans so that they can keep their lending staff employed. So now, with that knowledge, a couple things have started to happen. And I had suggested earlier in the year, when mortgage interest rates really spiked, went from approximately 3% at the beginning of the year and spiked to almost 6%. And I don't remember exactly when that was, but sometime in the sort of March, late March, early April timeframe. So a few months ago, I had suggested the mortgage-backed securities bond market had gotten ahead of itself, and it had priced in a very much higher level of tightening in the Fed funds rate and signaling from the Fed than had actually occurred. And so what was likely to happen was the mortgage-backed securities market, people, investors, would start realizing mortgage-backed securities bonds were underpriced. They were paying too much interest. And so they'd start to come back into the market with some significant demand, which would pull interest rates, mortgage interest rates, back down. Well, exactly that has happened. And so mortgage interest rates have come back down from around 6% to this past week on Friday, national average for a 30-year fixed rate mortgage, 4.99%. So under 5. Now, is that 3.2% like in January? No, it's higher. But it's not nearly what the bond market had been indicating in the March-April timeframe was going to be likely. When a lot of people were panicked, oh my gosh, interest rates are going up, they're going super high, it's going to collapse the housing market. And I said, don't worry, interest rates are a little bit higher, affordability numbers actually better than they had been in 2006, and interest rates are going to come back down. And interest rates generally have been coming back down over approximately the past 10 or 11 weeks. There is another spike that had occurred and they've come back down and they're literally below 4%. I have a client who just closed on a purchase for something almost 4%. I have another client who went into contract and they're just slightly over 4%. Looking at some of the builders out there, they are concerned about what's going on in the mortgage market, and some of the builders have sufficient access to capital. They're buying down interest rates for some of the buyers in their communities. And so you can find communities, new construction communities, where if you go with the builder's lender, you can get interest rates as low as 3.75%. And long-term locks, like 5-month, 6-month locks, with rates at 4.99, 5.15%. So are those rates higher than they had been last year? Absolutely. Are they higher than they had been in January? Absolutely. Are they high by any kind of historical measure other than this past 2 years during a pandemic? No, they're not. They're not actually that high. But they're above where they had been. But they're also below where they'd been the week before and the week before and the week before and etc. Going back to approximately April, interest rates have generally been coming down since April. Now, prediction about the future, the Fed is clearly still concerned about inflation. They believe that the economy can sustain more interest rate hikes. They're likely to continue to increase interest rates at least for a little while longer. We'll talk about that in a second. Will that cause mortgage interest rates to go higher than where they are right now? Mortgage interest rates, as I had said late last year, this year would be higher, and they likely would be fluctuating between about 4.5% and 5.5%. So I'll adjust that slightly, and I'm going to say interest rates are going to fluctuate this year from this point through the end of the year, probably between about 4.5% and 6%. So very slightly higher than where I had anticipated they would be, but also very much in line, and not end of the world problem catastrophe, super high interest rates. So I said there's a problem and the Fed will stop raising interest rates. The Fed has a dual mission. One half of its mission is to prevent high levels of inflation. So inflation is caused by, generally, excess demand. But we also know inflation is caused by supply problems. So as we'd seen last year, the price of housing kept going up. And that's not inflation, it's actually asset price appreciation. That's not included in inflation. But rents kept going up, and rents are an element of the inflation gauges. So as housing prices appreciate, they're likely to drag along with them, with some lag and some disconnect in terms of level of impact, rental prices. So over time, certainly as there's more appreciation in housing prices, there'll be inflation in rental prices. But they're two separate things, and we do see certainly rental prices going up. And so there's some inflation in the housing market. There's inflation in the fuel market. There's inflation in many commodities markets. But last year, we were seeing price appreciation at a high level, approximately 24% year over year at the end of the year. So during the course of 2021, for single family resale residential properties in the Las Vegas Valley. That's a lot of appreciation. In some markets in Utah, appreciation much, much higher than that. Coeur d'Alene, Idaho, much, much higher. Memphis, Tennessee, very significant, almost twice that level of price appreciation for houses. So Las Vegas wasn't unique. This was actually going on all around the country. And I'd commented at that time, last year, 2021, we had record sales for pricing, for single family homes, as well as for condos and for townhomes. But prices kept going up. Well, what did that mean? That meant that last year we had a demand-driven price increase because the supply curve, while supply was limited, the supply curve shifting out would have resulted in reductions in demand, reductions in numbers of houses that were transacting in face of the escalating prices. Last year, prices were going up and demand kept increasing. It was a demand-driven phenomenon. This year, we have numbers of transactions decreasing while prices are going up generally. And again, we'll get into the particular details as we go later into the video. But that means a lot of what we're seeing right now are supply-driven problems. Well, it's not just housing, right? There's a war that Russia invaded Ukraine, and it caused significant dislocation into the oil market, which has caused significant increases in oil and all oil refined products, especially, of course, gasoline, which has caused gas prices to go much higher. That's inflation. It's part of inflation. Inflation is a generalized increase in prices. But oil prices going higher means also that food prices go higher because you use oil to grow food, to harvest food, to process food, to distribute food. Also, the war in Ukraine has dramatically impacted the level of corn and soybean and wheat supply into the international market, which means that the demand that's out there needs to be supplied, needs to be met. The market needs to clear with a lower amount of actual grain. which means that more people will bid for the grain, prices go up, so demand goes down, so that the market clears. Okay, so there's inflation on that side of the foodstuffs industry as well, right? So we've got a lot of inflationary pressures. Computer chips for phones, cars, computers, etc., short supply because they're stuck in ports around the world because shipping containers are misplaced. We started seeing during the pandemic lockdowns that were very destabilizing of supply chains, meaning supply was interrupted. Why do I say that? Why do I dwell on that for more than a second here? Because most of the inflation that we have in the US economy right now, and this is all around the world actually, the US is not unique. Inflation is very similar throughout Europe. It's very similar in most countries in Asia right now. It's similar in Mexico, in Canada, right? If you control for currency fluctuations, we're seeing the same kind of inflation all around the world. It's not related to policy in this country. It's related to significant supply disruptions. Well, so you increase interest rates, you're reducing the demand for money because you're making money more expensive. If you reduce the demand for money, you reduce the amount of consumption writ large that can take place across the economy. You're driving down demand, believing that reducing demand will reduce the level of activity in the economy, sort of definitional, and therefore you'll bring down inflation because fewer people are demanding as much of whatever they'd been demanding before. Well, that works if inflation is demand driven. It doesn't work very well if it's supply driven. The inflation we have in the US economy and the world economy right now is a largely supply driven phenomenon. And therefore increasing interest rates is actually not just not likely to help the inflation environment. No, it'll pull down demand, definitely. Reduce demand, you reduce the number of things that are wanted in the economy, and it'll cause a lower level of economic activity, which will, at least in the short run, seem to get rid of inflation, but does not address the supply problems. So let me give you an example. In the Las Vegas Valley, there's, of course, resale housing, but there's also new construction housing. You drive around, it's very easy to find new construction neighborhoods going up in the northwest, the northeast, the southwest, etc. around the valley. Well, as interest rates go up, it becomes more expensive to buy a house. If you put a contract on a new construction home, let's say last year, and you qualified to borrow, make up a number, $500,000, and you're going to put in $100,000, and you're buying a $600,000 house, so you qualified to borrow $500,000 at 3.5% interest. And now you're being called by the developer and told, your house is finished, we're ready to let you close. And you go to your bank, and your bank says, it's 5% now. It's not 3.25%, 3.5% where you had been before. And the bank then says, I'm sorry, you can't borrow that much at that interest rate. And so the buyer is no longer qualified. The buyer drops out of contract. And the seller now has, the builder now has a newly built house sitting in inventory looking for another buyer because the original contracted buyer cannot afford to close. So if the building process took 1 month, like a resale process, the exposure is very little. But because building times due to supply problems over the past year and a half, building timelines have extended. We've got clients who literally are in 2-month-long construction timelines, and interest rates are changing and going higher, and some buyers are being forced out of those contracts. What's that do to the builder? It saddles the builder with a completed, meaning expensive, right? They have put in all of the work to build the property, and now they're carrying it on their books. They thought they'd sold it. Now they're carrying it on their books as inventory, trying to sell it again because the original buyer no longer qualifies, has dropped out. So if you're a builder and you've got that problem, your expenses just went up. In fact, they've already been going up because you're taking longer to build the property because you can't get the supplies, and the supplies themselves have been going up in price. So your margin, your profit on building that house has been getting smaller as you're taking longer to complete the house, and now your buyer dropped out. Well, what that means is builders now are finding themselves in a position where they're having to build fewer houses. Well, we have a housing supply problem in the Las Vegas Valley. We really do. We have too few houses in the Las Vegas Valley. That's the reason we've seen these strong price increases like we had last year and the year before. Price increases which were being driven by demand because more people want to be here than there are houses to house the people who want to be here. And now builders are building fewer houses because their costs have gone up. Borrowing money to build new port infrastructure, to import and export, more expensive. Borrowing money to build new lanes on freeways, more expensive. Borrowing money to build new factories, to build batteries for electric vehicles, more expensive. Anything that requires one to borrow money, a company, a government, whatever, to borrow money to engage in the productive activity has become more expensive because the Fed has decided they want to get rid of inflation by increasing interest rates. But if you increase the cost of building the factories and upgrading the ports and building the infrastructure and building additional houses, what you're really doing, you're temporarily lowering demand and therefore you're lowering inflation because fewer people are looking to buy something. You're exacerbating the supply problem. And so what the Fed is doing is actually really problematic. And I don't know, I can't explain to you why they're doing this because it's wrong. It is actually bad policy that they're engaged in at this time. But it's what they're doing. So interest rates have been going up, which is causing the economy to slow, which causes inflation to come back down a little bit. Well, what are some numbers for that? So we know how much interest rates have been going up. Consumer confidence has been falling over the past approximately 5 months. And the rate of growth of the U.S. economy since the beginning of the year has been falling. In fact, it's fallen so far. The rate of growth of the U.S. economy was negative in the first quarter and was negative again in the second quarter. Meaning from basically January through June, the U.S. economy has been shrinking. Now, the lay definition of a recession is 2 quarters of negative economic growth. And so per the lay definition of a recession, we're in a recession right now. Now, the actual technical definition of a recession is different. The technical definition will surprise you if you don't know what it is. It's actually a statement issued by the National Bureau of Economic Research. A group of economists get together and they vote on whether or not the economy is in a recession and when that recession started and when that recession ends. Now, they'll look at several things, including rate of growth, positive, negative, and how positive and how negative. They'll also look at employment trends and things like that. So there are a lot of politicians out there right now and a lot of people in the media who are saying, well, we're not in a recession right now, but we might be headed for one because interest rates are going up, which is slowing the economy. But employment levels haven't dropped yet. So we're not in a recession. Recession is not actually tied to the level of employment. It's not tied to the direction of the change in employment. Very interestingly, even though the economy has literally been shrinking over the past 6 months, employment levels have been increasing. Why would that be? Why would companies hire more people even though maybe demand is going down and they're selling less stuff? Well, it's because they had a real shortage of workers before. The supply of workers, the availability of people to hire had been so constrained because people were stuck at home or whatever, that businesses are out there hiring and concerned that if they don't hire, they're not going to have enough people to make the things that they make to be able to engage in the commerce that they want to engage in when demand starts to rematerialize. How long that goes on, I don't know, that's anyone's guess. But kind of interestingly, on a national level, the unemployment rate in July came down to 3.5%, lowest it's been in over 50 years. Really low, actually, according to economic theory. That is below the rate of full employment. And we're actually getting into frictional employment and a couple of other issues that prevent unemployment from ever becoming zero. Structurally, it can't go there. So 3.5%, really low level of unemployment. And we added another, I believe the number was 528,000 jobs in the month of July. Really big number of new jobs added in a particular month. A typical month sees employment gains of between about 200 and 300,000 people in a growing economy, but we've been shrinking over the past 6 months. We've regained all of the jobs, numerically, all the jobs that were lost because of the pandemic shutdowns. We're actually, the US has more people employed in the non-farm economy now than at any time in the history of the US. It's pretty phenomenal. Actually, the only really major part of the economy where employment is down, US, is government employment. State, local, and federal government employment is down as of the July numbers, approximately 600,000 from where it was pre-pandemic. So let's say the end of 2019. 600,000 fewer people working in government. But those people, numerically, right, it's not necessarily the individual went from government to something else. And an individual may be unemployed still, but numerically, more than 600,000 people have been put to work in other industries above what had been before. And so overall employment is higher than it had been before. Well, what about in Las Vegas? In June, because the state numbers are behind what they are for the national numbers, the state numbers for Nevada in June and Las Vegas following suit crested, meaning exceeded for the first time, the pre-pandemic employment numbers. So we've recovered all of the employment. Now in Las Vegas, it's a little bit different. It's kind of interesting, actually. We are down approximately 32,000 workers at the end of June in leisure and hospitality, right? We have an economy which is dependent on leisure and hospitality, and we've been wanting to diversify that economy for long periods of time. And we now have more people employed in Nevada and in the Las Vegas Valley than ever in history. But leisure and hospitality, we're down by about 32,000 jobs, which means that the employment growth that's happened in Nevada and Las Vegas has actually managed to diversify our local economy, which is beneficial, right? Leisure and hospitality tend to be among the lowest wage level jobs. And so these new jobs are likely coming in at higher wage levels. As well, leisure and hospitality jobs are pretty dependent on how tourism is going in the local environment, and non-leisure and hospitality jobs are not as dependent. So it gives resilience to the economy. It gives resilience in a second way as well, which is if there's a negative on one part of the economy, there are people who are employed in other areas of the economy. Now, it's likely that employment numbers when they come out for July for Las Vegas will actually be really good because we've started to see a return of convention business. So June convention business was the first month where we actually saw convention visitors exceeding approximately 150,000. I don't have the exact number right in front of me right now, but approximately 150,000 since the start of the pandemic. So conventions are just starting to really, in large numbers, come back into the environment. That's actually caused weekday hotel occupancy numbers to go up. And so for the first time since the pandemic, we've seen weekday occupancy numbers, not weekend, weekday occupancy numbers in hotels hit 80%. Right during the pandemic, they had gone down to less than 20%. We had hotels closing, almost all the Strip, closing during the week and only being open Thursday, Friday, Saturday night. So now we've got the hotel rooms open and they're operating at 80% capacity. And by the way, in Las Vegas, 80% is an okay number. It's not super amazing. Las Vegas hotels, when things are going really well, tend to be 90, 92% occupancy. Outside of Las Vegas, if you've got occupancy levels above about 72%, you're considered to be in a successful hoteling operation. Right, so 80% is a profitable number. And in fact, we've seen more than a year now of record profits being generated from the resort industry. We've seen more than $1 billion in win from the resort industry for a year. It's remarkable, right? This is the first time that's ever happened. So that industry, let's just say leisure and hospitality, has been showing significant profitability and doing so actually with lower employment levels, which will start to rematerialize because if you're going to run a hotel with high levels of occupancy for 7 days a week, you need more people than if you're running a hotel only 3 days a week or with lower occupancy for 7 days a week. Same thing, you need more people at the convention center, you need more people at the downtown convention center, you need more people in all of those activities and places that tourists are arriving. How else do we know that tourists are returning? June is the first month that we've exceeded pre-pandemic numbers at the formerly McCarran, now Harry Reid International Airport. Record number of travelers through the airport in June of 2022. And international travel has started to rematerialize again. And it's not just because some people in Las Vegas are traveling overseas like we did at the beginning of July. It's because we've got Korean Airlines is now flying again direct to Seoul. We've got Lufthansa, who lost my luggage, so I don't really like them, flying direct via some weird arrangement with Eurowings, Discover, Finnair to Frankfurt and to Munich. We've got Swiss Air direct to Zurich and back. Right, there's a bunch of international travel that is now just started to really rematerialize. Those numbers are still way down, but as the seats on international airlines start to really increase back into Las Vegas, those numbers are going to start to really go up. And that's great for our economy, by the way, right? That puts people in hotel rooms, that puts people in restaurants, that puts people in theaters, that puts people in concerts, it puts people in sports arenas. It's kind of interesting. The Raiders basically sell out every game during their last season. Will be again this season, right? That's partly because almost every seat is covered by a season ticket. But the Raiders actually managed to sell to tourists a greater number of tickets than any of the other stadiums. So people are reselling those tickets. People are coming to Las Vegas and they're sitting in those stands and they're buying food in the stadiums. They're flying in, they're flying out, or maybe they're driving in and driving out, spending money on gas, buying food, going to a play, maybe another sporting event, whatever, while they're here. Now, some of you may say, oh, that just means they're spending money, causing things to go up for the rest of us who actually live here. Most of you are realizing, though, tourism is a very significant driver of the Las Vegas economy. And so we rely on that to get people here, to have them engage in economic activity here. And so we want that. We absolutely want that. And it's interesting, the level of diversification away from that we've experienced while coming out of the pandemic. But we'll start to see that part of the economy really strengthening here over the months of July, likely August, September. So those are all really good things. Now, I will tell you, consumer expectations about the future, down. Consumer confidence, down, right? The Federal Reserve is making things harder. Interestingly, consumer expectations about inflation, reported earlier today, the 8th of August, have started to moderate, which is really good news, because with the employment numbers, there have been a lot of speculation, oh, the Fed's just going to really increase interest rates now because so many more people went to work last month. But the Fed is concerned, yes, about inflation. They're really concerned about inflation expectations, because if one expects inflation is going to go up, they're going to change the way in which they engage in purchasing behavior. And so if they think that inflation is slowing down, they'll change the way they engage in purchasing behavior. And so to the extent that the Fed believes that the statistics show that consumer expectations of inflation are moderating, then 3/4 of the battle against inflation is being won by what they've done, at least in terms of slowing levels of demand, which means the Fed can slow down on its quest to really put the economy into a recession by raising interest rates. Yeah. I told you the Fed has a dual mandate: keep inflation down. The other part of the mandate is to keep employment high. As you slow the economy, generally speaking, because you're increasing interest rates to curtail inflation, you cause the economy to shrink. And when the economy shrinks, that generally means unemployment goes up, because as there's less demand in the economy, businesses want to produce less, and they lay people off because they don't need them to produce less. Again, we're in an unusual environment, because we had a forced shutdown of the economy, which led to massive levels of layoffs, which means that we've been producing in this economy now over the past, 9 or 12 months at a higher level with a lower level of employment than would normally be the case. And we're just catching up on employment. So we haven't seen employment levels coming down. We've seen it in a couple specific industries, which have been very sensitive and leading to some layoffs in particular industries. But actually, even layoff numbers are below where they normally are in a non-recession in the economy. So at this time, I would argue we're probably in a recession. It's a very unusual recession, but I'm not a member of the NBER, and so I don't know. But anyone who tells you, oh, we're not in a recession because employment's not going down, they're making that up, because they're not members of the National Bureau of Economic Research either, and so they don't get to make that declaration. The lay definition of a recession is 2 consecutive quarters of negative economic growth, and we certainly meet that criteria. We may actually be in a recession right now. Fortunately, recessions are not inherently bad for the real estate market. So that's good news. All right, all that. And by the way, home builders, the statistics show it. I told you they're being negatively impacted. Home building permits, ground breakings, and new contract signings for new construction they're all down. They're down in June, they're down in July. The home building industry is being impacted significantly, and they're being impacted in ways that are actually reducing the level of new inventory, new construction inventory that can come into the market to help us with long-term housing number problems. So I'll just throw that out there. That's where the Fed has put us. But what about the resale market? Well, let's go ahead and look at the resale market, specifically single-family resale in the Las Vegas Valley. There's a companion video for condos and townhomes, and I'll do that as well. I pulled that data today. That may be a day delayed in getting out there because I want to make sure this gets out there. Now, some of these numbers sound a bit bleak, but we need to pay attention to the context in which these numbers are generated. So, the median resale price for single-family resale residential home in Las Vegas in July of 2022 fell $13,000 from $478 down to $465. That's a drop of 2.7%. A little context around that. Last year, we're up almost 25%. We just came down 2.7%. Now, in some local areas, like around Provo, Utah, Orem, Utah, there's some significant price drops because there are some problems that happen every time prices go up, right? Markets don't move in straight lines, up or down. There's fluctuation. And so to the extent that after 2 years of significant price appreciation, we're seeing some stabilization, a little bit of correction, is actually a good thing. There's nothing wrong with this. There's nothing unhealthy about this. We will, I believe, start to see pricing increase again in a couple of months. I don't think this is a changing trend. I don't think this is a long-term issue. I actually think that the August numbers, based on the first week of August, are going to be better than what we see for July. I think July is going to be the slowest month. Now, I was talking to one of my informants, a title company vice president, who was suggesting that actually August is a constrained month because of school starts. So there is that challenge that we get seasonally every year at this time, which may pull August numbers a bit lower than what I would otherwise anticipate. But looking at the actual data from the first week of August, August is starting out stronger than July started. So August may be flat. I don't think we're going to see deterioration in the month of August. And we'll talk more about that as we go through the rest of the data. So July of 2022, 465,000. That's up 404. It's not up that much. It's up from $404,700, $750 in July of 2021. So it's up 14.9% year over year. And if we just look year to date, so January 1st through July 31st, we're up 9.4% year to date, from 425 to 465. So we're up. Yes, we came down this past 2 months. We came down $2,000 in June, and we came down $13,000 in July. We're down $15,000 overall, less than 3% in this correction. Now, price per foot. I look at price per foot because that tells us something about the internal of the market. If price per foot is shifting more quickly or in one direction vis-a-vis median sale price, then that suggests something about the mix of properties that are selling. The median price per foot for July of 2022 was $261. Now that's down $2 from $263, or down 0.1% from the prior month. We're up over the course of the past 12 months from July of 2021. We're up from $219. We're up 19.2%. Now, we're up 19.2% on a price per foot over the year, and we're up 14.9% on a median sale price over the course of the year. We're down 0.1% price per foot over the past month, we're down 2.7% for median sale price over the past month. That suggests that we are actually seeing a small, not big, but small shift toward a little bit more transaction on the higher end of the market, and we're losing a little bit on the lower end of the market. Now that makes sense because some buyers are more marginal, if you will, than other buyers. They're a little bit closer on the line as to whether or not they may qualify for borrowing as interest rates go up. And so we may expect that those buyers who are a little more marginal are probably in the lower half of the price spectrum for a property. And so more of those transactions probably do not take place than those at the upper end of the price spectrum, where buyers may not be so reliant on mortgages. They can pay cash perhaps. Now, buyers at that upper end of the spectrum are probably more prone to feeling wealth impacts from increases and decreases in their stock portfolios and certain other issues. But they're a little bit less impacted probably on the interest rate marketplace. So we do seem to be seeing a little bit of a skew toward the higher end of the market. It's not real pronounced right now. The 19.2 versus 14.9 or 19 versus 15% at the median sounds a little bit large, but you'll remember there was a couple months last year where we skewed toward the lower end of the market, and this is partially making up for that. So we're down 0.1% price per foot, down 2.7% median sale price. I think that that's the more valid comparison. All right, number of units sold in July, 1,979. That's down 23.5% from where we were the prior month at 2,587. Interestingly, that number, if we look at the month-to-date numbers, so sort of the first 7 days of the month of August, the number was 513 sold. And so if we multiply that by 4, figuring 4 weeks in the month of August, that number would be 2,052. So that would tell us that we're actually up a little bit at pace for the first week of August than where we were for the month of July. And it's one of the reasons why I think that August is probably a stabilizing month here from whatever downtrend there may have been over 2 months, not really much of a trend, and that we'll probably see growth from that point on. August may surprise us and turn out slightly higher or slightly lower, but I don't think it's going to be much of a change. Okay, so that number though is also down. The 1,979 sold. It's down 40.1% from where we were last year, 3,037. Remember though, last year I've been saying all year long, and in fact late last year I was saying 2021 will create difficult year-over-year comparisons because it was the strongest volume year ever. And so that's not really a particularly interesting number to look at, but I throw it out there just for consistency of what I look at every month. Pending home sales, a little bit challenging. Pending home sales for July, 1,872. That's about 107 lower than closed. So that suggests August may still slow a little bit. But anyhow, let's look further at this. 1,872, that's down. It's only down 6.5% from the 2002 pending home sales that we ended June with. Now remember, pending home sales look forward in time. There's statistics from what happened, contracts that were entered but not yet closed, so they tell us something about what we should expect will be closing in the next month, so into August. So the pending home sales in July were down a little bit, down 6.5% from the month prior. We might expect then, okay, August sales are going to go down a little bit. But interestingly, again, looking at the first week statistics for the month of August, that number was 775 for contracts that entered in that first week. So multiply that by 4, that's 3,100. So that would be considerably higher than the 1,872 pendings that we saw in July. So it looks like more contracts are being written. So that's actually good news. Looks like whether those close in August or they close in September, it looks like, again, stabilization and some change in movement toward more transactions than what we'd seen. Pending had been 3,081 in July, at the end of July of 2021. Again, very strong year last year, but that's down 39.2%. So again, I put that out there just so you have that. I do not think it's a particularly interesting number. For sale. Now this is interesting. For sale, 7,674 single-family resale properties at the end of July of 2022. That's up. It's up substantially. It's up another 19.3% from the 6,431 that'd been for sale at the end of June. It is also up a lot. It's up 60% from the 4,796 that we saw last year at this time. So that suggests that we're getting significant supply into the market. Now, what's normal? Normal is something more like 9,500, 10,000 houses in the market. So we're still below normal. We're below normal by about 20, 25%, but we're really coming back, approaching normal conditions in the inventory in the market. And so we're still in a buyer's market. Regardless of what anyone tells you, we're still in a buyer's market and transactions are happening. And so don't expect, prices are dropping all over the place. It's not the statistical view that we're seeing. Prices are down less than 3% from the very top, and they're likely to stabilize and start to turn here to go back up. All right. New listings. Now, new listings are interesting because those are newly entering into the market. Resales that have just gotten a listing agreement signed by a realtor and they get posted into the MLS during the course of the month. 4,411 in July. That's actually down from the 4,770 that entered into the market in June. It's down 7.5%. Personally, I think that that's good. There are some out there who think, people really want to list and everybody should be listing right now. I think that we need to be careful as real estate agents about trying to get people to list because people might be a little bit scared about what's going on because they've been hearing all these horror stories when they turn to social media. If one needs to sell your home, if you're moving out of the area, you need to sell, or your house is the wrong size, you need to sell, or you're saddled with a particular mortgage that you need to change the shape of and it cannot be refinanced. Selling is perfectly fine and listing your house is perfectly fine. But if you're just being convinced that, the market's going down, you better get out now before prices collapse, people are lying to you. That's not what's going on. You do not need to get out now. Prices are not collapsing. You have an asset of great value. And so do not be swindled into thinking things are turning really bleak. That is absolutely not what's happening. So we are up from 9.1% from the number that we had enter into the market in July of last year, 4,041. We have slightly elevated numbers, looking back across time, slightly elevated numbers of new listings into the market during the month of July. June had higher new into market, and so it was elevated a bit more. But overall inventory is still down by about 20% from normal. So we're catching up to that normal inventory. And when we get into normal inventory, what do we have? We have a balanced marketplace. So that we're below inventory means we're still not in balance. We're approaching normal. We're not quite there yet. Now, Two other things I want to note. One is back on market. I've been talking a lot about back on market over the past year or thereabouts. Back on market numbers for the month of July, 972 single family homes. Now that's down. It's down considerably. But of course, sales were also down. Contracts were down. So this is percentage wise 32.9% of all contracts failed. Now remember, I started recalculating this number 2 months ago to use a different formula. So this is all contracts that did close plus all contracts that failed as the denominator with a numerator of all contracts that failed. So this says it's not just failed to sold, it's failed to actually all of the contracts that had a final conclusion during the month. And so that number is 32.9%. This is down. It's actually the lowest we've seen in well over 6 months. It's still a bit high. It's higher than I would like to see. This number really should be something closer to 20%. So we're still high. But this suggests actually that some things in the market that have been causing back on market statistics to be high have actually been mitigated a little bit. Now, this is interesting because nationally, back on market numbers have started to go up. And there have been a lot of really nasty, negative, bleak commentary in the social media marketplace about how back on market is super elevated, and it's because everybody's dropping out because they realize the market's going down and they don't want to be in these contracts. And BS. This is not the case. I've been looking at back on market for a while and I've seen the trends, and back on market's elevated, but it's actually coming down. It's been elevated for a variety of reasons, which was not prices were falling. It's been elevated because prices were actually going up and there were failures of appraisals. There were sellers who were thinking, since prices are going up, I don't need to make repairs. And so things would fall apart over repair requests. So as the market stabilizes and normalizes here, as we get into trends that look more like normal time, normal years, as opposed to what we had over the past 2 years, we'll see this back on market number start to trend down as we're seeing it trending down right now over this past month. So that's really good news, but it's still high. It's almost a third of contracts are falling out. And so it is still something to pay attention to and to note. When you get into a contract, it's still really important to try to make sure that you are doing everything you can to protect yourself, to protect that contract, to make sure that it actually closes. So the last thing I want to talk about is affordability. There has been a lot of really negative commentary out there. Oh, nobody can afford to buy anything any longer. It's so expensive. It's more BS. Looking at sort of cycles in the housing market, right? Housing prices go up, housing prices stabilize, housing prices go up. That's a normal cycle. The financial crisis, which punctuated that normal cycle with a sharp drop from 2006 to 2012 in the Las Vegas Valley, in most parts of the country, sort of 2008 to 2010. Very unusual that the housing prices actually went down as opposed to sort of stabilizing and then heading up again. But if we think about that as being a cycle, a large cycle in the housing market, we hit a peak, then we stabilized, or in fact actually came down on that cycle, and we've gone back up, and maybe we're at a peak, maybe we're not, maybe we're close to it before we stabilize again. Well, we're actually stabilizing, I'd suggest. We were at what amounted to, on an inflation-adjusted basis, $448,000. So we're just slightly above that at $465,000 at the end of July, right? Less than $20,000 difference. But that $448,000 median house was acquired with an average mortgage, an average, assuming it was not an adjustable rate mortgage at the time, which were prevalent. A fixed rate mortgage, 30-year fixed, was at 6.75%. So June 2006, at an inflation-adjusted dollar level, one was paying for the median house with a 90% loan-to-value loan $2,595 per month. Now, if we take at the end of July, median sale price $465, at the end of July, average 30-year fixed rate mortgage interest rate 4.99%, and we do a 30-year fixed rate loan, 90% loan to value mortgage, $2,331 per month. We're $264 per month less than what we were seeing in June of 2006. Now, June of 2006 does not create an absolute cap. It's, nobody could ever afford more than that. I just use that as a comparison to what people were actually affording in 2006. Here we are at the end of June, so of 2022. So what's that? 22/6. That's 12. 12. That's 15 years later, and we're $264 less per month to buy the median single-family home in Las Vegas than what we had at that time, all that time ago. So affordability, as I've said in other videos, and there's a political and philosophical argument about whether or not everybody should be able to buy a house. I get that, but that's not the reality of the environment that we live in or have ever lived in this country. Some people can afford and some people cannot afford to buy a house. The distribution of people who can afford to buy a house in Las Vegas Valley is larger now than it had been in June of 2006. Is it larger than when the bottom of the market was being put in place? No. But we are where we are, and people who want to buy houses can afford to buy houses. They're not being priced out of the market. Now rental rates certainly are going higher, and rentals are becoming more expensive. And so, we could end up, we already have a housing crisis. There's not enough houses in Las Vegas for people to buy. We could have a rental crisis as well, that there are not enough rental units. Fortunately, there's a large amount of multifamily housing being built, apartment buildings being built in the Las Vegas Valley right now. But that's not going to keep up either. We need more construction, and high interest rates are, unfortunately, the bane of the ability to create enough new housing in the valley to be able to house all the people who are moving here. So we don't want policies that are going to create homelessness. That's not good policy. Right? We can look around parts of California, we can look around Montreal, we can look around Toronto in Canada, we can look around different places and see what happens when societies decided to prevent housing units from being built, but people want to live there. We don't want that kind of situation. We've never in Las Vegas wanted that kind of situation. And yes, there are some homeless in Las Vegas for a variety of reasons. We have not yet created the urgency in the housing crisis that's causing people to become homeless because there's simply no housing. Let's hope we don't get there. That's actually my bigger concern about what's going on in the housing market right now because of elevated interest rates. Anyhow, I'm Justin Miller. I'm one of the co-founders and principals of the Chong Miller Group. And at the Chong Miller Group, we help people buy and sell homes. So thank you very much for listening. I appreciate it. And I will look forward to seeing you in the next video.